All right, let's keep this conversation going, folks. Joining us on set is Dunn. He is fund manager and head of value equity at Morgan Stanley Investment Management. His fund outperforming the S&P 500 so far this year. And Aaron, that is not an easy thing to do. So welcome. How have you done it? Do you think the investing narrative that we just talked about, Victoria, has indeed changed?
Definitely. We were on late last year, and we talked about this, and this was the sort of crowding in the U.S. equity markets, right? And so really, when you look at what's been going on in the markets, it's been this reversal of what's happened the last 2 years, right? Values outperformed growth. Internationals outperformed. So a lot of the things that we believe were very crowded have just simply reversed at this point. And even earlier this week, when the market got into a lot of volatility, it was a lot of risk positioning. It wasn't really a wholesale sale of the market. We would argue today is a little more breadth in the market in terms of selling. But on Monday, we could show you stocks that had not done really well that did extremely well, right? So those are risk desks that are readjusting sort of risk in portfotfolios across the hedge fund.
Readjusting from what to what?
From a position of leaning into Mag 7 versus, shorting other industries, wherever that is, that was reversing, right? And so we've seen that reversing, and that's been going on all year. What we're seeing today seems a little more broad-based to me. It seems a little more of a liquidation piece, which is the market, in our view, even in the last year, was very focused on U.S. equities, right? U.S. equities had massively outperformed. They were a huge part of the international markets, right? They're 70% of MSCI. So we're a very crowded trade. And what we're seeing is the unwind of that. And so we think it probably has more to go, but I don't believe this is the end of U.S. equity performance.
We don't
That's
know.
hard to say. Yeah, it's hard to say. You never know because you never know what's behind all these, right? You don't know where leverage positions are. You don't know where the bodies are hid, so to speak, in the market. So
I'm going to say something.
I'm
going to say something so you don't have to. Some of this is healthy, and I don't want to see anybody lose any money. But I've been doing this almost 30 years, and when I see companies trading at 50 times sales or 75 times projected earnings. Unless the world has fundamentally changed. And by the way, with AI, I think there are parts of the world that have and will fundamentally change. But to your point, so many people were stampeding into the Can we throw MongoDB up here? And I'm not knocking MongoDB. By the way, best name company, I think MongoDB, right? Stock's down 23%.
Yeah.
Because a lot of these super high value, super high momentum, super profitable names, to your point, I think, Aaron, got way too crowded.
Exactly, right.
And I don't like that attitude where things will never go down. Is there any truth? You can interview me now. Is there any truth to what I'm saying?
I think this is extremely healthy, actually. And there's a lot of good businesses who are just not getting focus from investors because everyone's really crowded into the Mag 7. They're crowded into the technology trade, right? And so there's not an infinite valuation we can put on these equities. So we really want to focus on businesses that we would call all-weather businesses in the market that can, whatever the volatility is from the administration, it's going to be daily. Until we get any certainty, the market does not like uncertainty. So you're seeing the unwind of that, and we think it's very healthy in sort of reestablishing positions in what I would call all-weather companies.
Here's what's a little confusing for those of us on this side of the camera, which is that lower rates were supposed to be good for equities. But yet now we're in a world where, as Steve Leisman would have told you, rate cut probabilities are rising. The bond market is shifting. Rates are coming down. And yet equities are not responding.
Yeah, but it was always, why are rates down? Right? It was never a blanket statement of, if rates are down, that's good equity. Okay, well, let's talk about why rates are down. Are rates down because it's a defensive trade on the short end of the yield curve? I would tell you that's what it is today, right? Even the 10 years now gone down. So there's a defensive layering on in the fixed income market that's coming out of the equity markets. People are rebalancing those portfolios. So I would say that for that reason, it's not bullish equities. Now, if you said the Fed thread the needle and we had great growth and there was, potential to reduce rates to help the housing market, whatever, I think that's great equities, but that's not where we are today.